Hi, everyone, and welcome to SEG's live webinar discussion, Craft a Winning Pricing Strategy to Maximize ARR Growth and Valuation. I'm Austin Hammer, a principal here at SEG. We're so excited for our conversation today. Thanks to our guests for tuning in. Today, we're going to cover several areas, including why pricing is a critical growth driver, how to plan and execute price changes, how to use pricing to improve metrics, and ultimately, how those metrics impact company valuation. We are so excited to welcome our featured guest, Stephen Forth, CEO and co-founder of SaaS pricing solution, Ibica, who will provide strategic guidance and actual insights for the implementation of effective pricing strategies. He's joined by SEG's very own Paul Chance, co-founder of Smartware Group. Paul serves a key role at SEG as both a former SaaS founder and previous client of SEG's. He will provide a unique perspective grounded in real-world experience. The discussion should take about 45 minutes, after which we will answer a few questions from the audience. To submit a question, click the Q&A button at the bottom of the Zoom app, and we'll do our best to answer them during the Q&A portion of the webinar. It's my pleasure to hand this off to SEG's Chief Industry Strategist, Paul Chance.
Thanks, Austin, and welcome, everybody. We are excited to have you join our fascinating conversation today that can help SaaS organizations in both the short and long term. Pricing strategy is an essential aspect of building a strong company. In the short term, you will build a better financial foundation that can make you a stronger, more agile, and formidable competitor. In the long term, a smart pricing strategy will help you build a more attractive SaaS organization to the buyer and investor communities, and ultimately attain a better valuation. I know this for three reasons. My personal background. I'm a former SaaS founder and SEG client that went through a successful exit. And although I'm very happy with the results, I know I could have done better with a smarter pricing strategy and resulting improved metrics. As Chief Industry Strategist, Technologist, and Evangelist, I now work with SEG clients, even informally, well before any M&A process, to share my wisdom and improve client outcomes. The second reason we know this is that SEG works with the many SaaS companies we bring to market and successfully find their next partner, private equity or strategic. We personally see how strong pricing strategies improve metrics and translate to better valuations. And the third reason is our relationship with the broader buyer investor community. They tell us the importance of solid SaaS financials, several of which are heavily influenced by a strong pricing strategy. We will dive into this conversation greatly aided by a seasoned industry expert, Stephen Forth from Ibica. Welcome, Stephen. Can you give us an introduction?
Thank you, Paul. So like Paul, my roots are in creating, growing, and exiting B2B SaaS companies. Back in 2006, I had recently exited one of my companies and was taking some time off when I was approached by a Boston-based strategy consulting firm, Monitor Group, now part of Deloitte, and asked to look at different frameworks they had developed to see what could be turned into software and taken online. I looked at a number of different things, but what got me really excited was pricing. Because as I learned more and more about pricing, I realized that if I'd known this stuff earlier in my career, I would now be a much wealthier guy.
We can go to the next slide, please. As we get into the webinar today, I want to start with a spoiler alert. If you pay attention to the wisdom that Stephen's going to share with us today, you will improve your valuation. One of the most common questions we hear when we're talking to prospective SEG clients is, what are the multiples around ARR or other metrics? And although I'm not going to share any specific numbers today, I will tell you this. If you have a strong pricing strategy and resulting improved metrics, you will move to a higher multiple. You will move from that 3, 4, 5x to that 6, 7, 8, maybe even more by just having good pricing strategies. So important stuff we're going to cover today that I wish I had known more when I was younger in my career. Next slide, please. As I thought about my past and pricing strategies, I think the best way to describe it would be throwing darts. And I know that's not uncommon for SaaS founders that are building, growing software companies. I mean, in my situation, pricing was often driven by sales. Clearly was reactionary, sometimes tied to quarterly bookings, monthly bookings. Not a lot of planning there. Discounting, often on a whim, often around a competitive response. What I didn't really understand is the relationship to product roadmap. You know, that classic squeakiest wheel is asking you to add features to your product, and you're not sure, should we create another module? Should we do a pricing increase? The relationship to that. And then the fourth example I'll use is these user type challenges. We had a price per user, and we wanted to try to attract additional users to subscribe. But maybe they were more limited users, and we were always at odds with what we charge. It never really worked out properly. I think the best way to describe it is we didn't have a strategy. There were consequences, and I would say that you could describe them as poor economics. And again, I'm very happy with where we ended up. But had we paid attention to these kinds of concepts earlier on, we would have been able to improve these metrics such as ARR and gross margin retention and others that we'll talk about. In my case, I could have done better. So with that said, we'll turn this back over to Stephen, and we'll start with an important first question. How would a better pricing strategy have helped me?
Thank you, Paul. So why don't we start by looking at some really concrete examples? So my first example is a data provider for financial data. This company was charging a flat fee of $19,000 per year for its data assets that it provided as a subscription. Working together, we segmented their market by value and found a high value segment that was willing to pay an awful lot more. And in fact, we were able to increase the price for that segment by tweaking the packaging a bit, not a lot, from $19,000 up to $179,000 per year. You know, more than a 9x increase in annual recurring revenue for those customers. Another example was with a scheduling provider for a healthcare company, for healthcare companies. Now, this company was charging all users the same amount, despite the fact that some slots were worth more than $2,000 an hour, and other slots were only worth $200 an hour. They redesigned their pricing to take advantage of this difference in the value of slots, and the result was a more than 40% increase in annual recurring revenue. Another example is a company that was is a software platform for manufacturers that helps them implement digital product service solutions. They had a flat platform fee, and by adding a new pricing metric for connected devices and scaling that to the value of the device, they were able to increase their net revenue retention from 97% to about 120%. Next slide, please. And these three examples, I think, are typical pricing moves that can have a huge impact on results. So the first pricing move here is to segment your market by how your customers get value, and then package and price for each market segment. Peanut butter spreading, where everyone gets the same product at the same price, almost never optimizes your revenues. Another common tactic that works for many people is to differentiate pricing for different types of user. If different users have different use cases, different value paths, you should be pricing differently for them. And this can have a big impact on your revenue. And finally, you want to make sure that you are packaging so that you can create ways to pull all the different growth levers. Grow and package is when you don't need to upsell or change the package, but you have some form of usage or consumption pricing metric that as use increases, your revenue goes up. Upsell is when you move to a good, better, best packaging strategy, and you can move customers from your good to your better to your best tiers. And finally, cross-sell is the opportunity to sell other products or services that enhance the use and the value of your own package. So these are our three pricing moves that we should all be looking at and asking if we have opportunities to make these moves on the board. Next slide, please. So good pricing is where pricing aligns with value. And the reason this is so important is that people will pay more if they know they are paying for something that is of value. And really in B2B SaaS, that means economic value. Good pricing targets specific segments. And there are almost always some segments where you have an opportunity to raise prices. And one should also add a pricing metric that captures usage. And this makes sure that you can grow in package, which is one of the most powerful ways to increase your revenue. Next slide. Now, some of you are probably asking the question, in the current economy, where there are some headwinds, does usage-based pricing really work? Maxio, which is a SaaS billing platform that gathers a lot of data on this, recently released a report which showed that in 2023, companies that included usage-based pricing, or what they call consumption pricing, outperformed people with pure user-based subscription pricing in 3 of 4 quarters. And if you look at additional data from Zuora, you'll find that companies that receive between 20 and 30% of their revenue from usage-based pricing outgrow their competitors by between 10 and 19%, depending on the SaaS vertical.
Yeah, these consumption style pricing, we looked into doing this. And I mean, to me, if I understand you correctly, Stephen, tying it into, say, tickets, work orders, whatever the transaction metric would be, sort of the primary method within your platform, and have that be as opposed to a price per user.
Yeah, and we'll come to this in a couple of minutes, Paul. But the really critical thing here is that the usage metrics should not just measure use. It should be something that measures how your customers are getting value. So if you can find a usage metric that connects use to the value that you're providing to your customers, that's what gives powerful pricing.
Great, thank you.
So there are some common approaches to pricing. Paul mentioned what is probably the most common, random or accidental pricing. And I would say that this occurs in somewhere from 50 to 70% of SaaS companies. So if this is where you find yourself, don't worry, you're not alone. A lot of people start there. However, there's nothing good about this approach to pricing. And the reason for that is it's very hard to improve something that's random. And pricing needs to be adaptive and improve as constantly be adapting to the market as it changes. Another common approach is cost plus, where you understand your costs and you add your target margin, and that gives you your price. The good thing about this is it can protect your margin. The problem is, though, that it leaves a lot of money on the table, and unless you are the low-cost provider in your industry, it's a failing strategy. And the reason for that, of course, is your competitors. So some people price relative to a competitor. They price a little bit higher or lower than the major alternatives in the market. This is a good start. Being focused on competitors really improves your market awareness, and that's a critical success factor in pricing. The problem, though, is that it allows competitors to control the conversation and to define the terms on which you're going to compete, which is not really a successful long-term strategy. So the next thing that people do is they price based on their customers' willingness to pay, or as pricing people love to say, WTP. This is also a really good approach because it gets you listening to customers, and that's critical. Any pricing conversation should be a conversation about value, and you can only understand value by listening to your customers. The problem with pricing based on willingness to pay is that it allows customers to control the conversation, and in the real world, willingness to pay is something that you can shape. And the way that you shape it is with value-based pricing. And there are many studies showing that value-based pricing is the best way to optimize, either for revenue growth or for profit, or to find the right balance between the two. The downside of value-based pricing is it's more complex. You're going to need to invest in really understanding your customers, tracking your competitors. You're going to need a value model, a formal value model of how you're creating value for your customers, and you're going to need to monitor this over time. So it does require more effort or more investment, but if you can make that, that's what will have the biggest impact. Next.
So this concept about good, better, best. I mean, I know this very well. In the industry I grew up in, you could go to just any competitor, and we've had a lot of competitors. You click on their pricing link at the top of the screen, and you'd see that ubiquitous matrix that would nowadays seems to start with free and then moves to, basic professional enterprise call for pricing kind of scenario. And I vividly remember building spreadsheets where we took all our competitors and put them in there to try to figure out what our price is. Can you talk about good, better, best, how it works and how you can optimize that?
Yeah. So I just want to start by saying that I think good, better, best, or GBB, is a little bit over-indexed today. It's not always the best approach to packaging. It works best for product-led growth companies that have fairly simple and easy to understand offers. Having said that, there are two keys to success with GBB pricing. The first is to realize that there are actually two very different flavors of GBB. The first one, which we refer to as an aligned strategy, happens when you try to bring people into the right package for them right from the very beginning. So if they should be in a better package, that's what you try to sell them. If they should be in a good package, that's what you try to sell them. A very different approach is the upsell strategy, where you try to use your good package as an attractor that you bring people into at a lower price, but your success depends on upsell. So whenever you're starting, or even if you have a GBB approach, it's really important to have clarity on which of these two approaches you're using. Next slide. The second key to success with GBB is to use the highest price offer to frame the price for the buyer. So you've all been to a restaurant where there's a very expensive bottle of wine on the menu, and as a result, you probably buy a higher priced bottle of wine than you otherwise would have. And this is part of the psychology of good GBB pricing. So it's often the case that you buy, so if you have most of your customers in your best package, that is not a good thing. That means you have not properly designed your GBB pricing. You need to repackage and reprice so that there is a package that is framing a high value, and then you're driving your revenue through the package below that. So the psychology of how you frame your offer and how you anchor price in the buyer's mind is really critical with GBB pricing. And you often, there are a lot of anti-patterns here that, Paul, we can go into in the Q&A if people are interested.
Great. So the next topic we'll talk about is value-based pricing, the best version. Stephen, and maybe you can just spend some time to describe that, and we'll talk about the advantages of it.
Great. So the critical thing about value-based pricing is to find a pricing metric that tracks a value metric.
This concept of value, I do a lot of writing, research, and lecturing on the concept of digital transformation, which in its ubiquitous term, a digital transformation is when you can identify real world challenges, and I'm referring to your customers' challenges for those on the webinar, and how you can use technology, in this case, SaaS technology, to make improvements or give opportunities for growth, create value. This has become a foundational aspect, I think, in value-based selling. It's so important to how you think about your go-to-market strategy. I find it fascinating how you can tie that back into the pricing concept. So I know, Stephen, you have some examples here how to make that be a little bit more clear.
Yeah, so let's go on to the next slide. So let's just define a couple of key terms first. So pricing metric is the unit of consumption for which a buyer pays. So for example, you pay for gas by the price per gallon. The value metric, on the other hand, is the unit of consumption by which a user gets value. How far will that gallon of gas get you? And finding a pricing metric that tracks the value metric is really the key to successful pricing. So let's look at some examples. So back in the late 70s and early 80s, the jet engine manufacturers such as Rolls-Royce and General Electric had invested a lot of money in creating engines that were much lower maintenance and much easier to operate. But when they went around to the airline companies and tried to sell them these engines at a big premium, the airline companies were sort of skeptical. And they said, well, yeah, maybe, but how do we really know we are going to reduce our maintenance costs? How do we really know that these engines are going to operate more efficiently? And GE and Rolls-Royce had invested billions of dollars in developing these new engines. And if they couldn't get a significant price premium for them, it was going to be a really big problem. The solution, though, was to change how they sold the engines. So instead of selling an engine, they would lease an engine, and they would only charge for the amount of time the engine was actually being used to power an airplane. And as a result, they were able to get a lot more revenue per engine because they had shifted risk from the airline to themselves. And the reason they could do that is they had confidence in their analytics, in their knowledge of the engine, in their knowledge of how to operate and maintain it. And this not only saved Rolls-Royce and GE and basically destroyed Pratt and Whitney at the same time, it also created a whole new business model around leasing, which GE went on to build into a very, very large business unit. So let's look at a more software-centric example. So back in the day when the web was getting started, back in the 90s, web advertising was paid by impressions or eyeballs. How many eyeballs are going to see an advertisement? Now, just having an ad appear on the page is not a very good pricing metric because it doesn't really track value. Think of all of the things that pop up in your screen that you don't really notice. You know, as an advertiser, should you be paying for that? But if someone actually clicks on your ad, that shows that they noticed it and it was relevant to them enough for them to take a next step. So pay-per-click tracks value much, much better than impressions does and has basically completely replaced impressions as an advertising metric for anything that's online. And as a result, companies such as Google, but also Facebook, were able to win most of the advertising revenues online because they had a pricing metric that tracked value. Next slide. So another example of this is per user pricing. B2B SaaS is full of user-based pricing models. And I think the reason for that is that the first really big success in B2B SaaS, Salesforce, used user-based pricing. And many people thought if it's good enough for Salesforce, it's good enough for us. However, many, many applications are in areas where the number of users is not a good proxy for value. Again, looking at a healthcare scheduling provider that we worked with, they moved from a per doctor fee to a care path completion fee. Because what the health systems that they serve really care about are how many care paths get completed, because that's how the healthcare systems are getting paid. And this led to an increased average contract value of 20% and is expected to improve their net revenue retention by 5 to 10 percentage points. So, Paul.
Yeah, it feels to me like, I mean, I think it goes without saying that good go-to-market strategy, good sales tactics, you should know your value proposition for your target markets. So that hopefully is already common in how you go to market. Now you're just tying that back to the software and how can you capture that? So I think that's one of the key things is when you look back at your own platforms, where is that value being delivered to be able to capture that so that it can translate to these processes? Am I saying that back to you correctly, Stephen?
That's absolutely right. And one of the things that SaaS has changed is we now have a lot more data about how people are using our software. And if we design that properly and collect the right data, we not only have data about use, we have data about value. And tracking that value, that data about value, and sending it back to your customers can be transformative, not just in terms of pricing power, but customer success and reducing churn, and really giving you guidance on how you should innovate and where you should be driving your platforms and services.
I mean, I can see it. You go to do a renewal with a client, and if you can show that value, I mean, that conversation is going to go a lot easier. The next topic here is one that's dear to my heart because I came from an industry with a lot of competition where, you looked at each of the platforms and they're all good. They're all a little bit different, but not very different at all from a feature functionality standpoint. So how does this translate when you have companies with little or no differentiation?
Yeah. So the key thing to be aware of here is that value-based pricing only works if you have differentiation. So if you have no differentiation, you will be forced to default to competition-based pricing. But there are lots of different ways to differentiate. Differentiation is not just dependent, on your product's features. So as an example, a company in New Jersey, this is a famous example in the pricing space, was selling construction fill. This is the stuff that is used to fill up holes. And it doesn't really matter what's in it as long as it fills up the hole. Hard to think of something that has less differentiation than this. But there was one company that was able to find differentiation here. And what they did was their competitors were saying, yeah, we'll have that, load to you sometime tomorrow. And as a result, the construction company had to have people and equipment ready sometime tomorrow. That costs money. This company promised delivery within a 1-hour window and took a pricing penalty if it was not able to deliver within that window. As a result, they were able to increase their own pricing by about 3%, which is, in a very low margin cost driven industry. That's a big deal because that's money that dropped directly to their bottom line. So, I think that the lesson here is there are many different ways to find differentiation, and company leadership always needs to be thinking about this and driving their competitive and value-based differentiation.
Excellent point. So the next topic is how and when to increase prices. I'd love to hear your take on this.
So I think the key answer here is you should always be asking if you can increase prices. You should not be doing this in your annual reviews. This should be a topic that you're asking every month. But price increases that are the same for all of your customers, regardless of who the customer is and how well they are doing, often fail. So before you increase prices, you have to ask two questions. The first is, are you delivering value? And how much value are you delivering for each of your customers? And then the second question is, how much of that value are you capturing back? Are you getting paid fairly for the value you're delivering? So in a well-run company, 70% or more of the customers will be in that top right green quadrant, where you're providing a lot of value and you're being well paid for that value. Now, you can't be complacent here. If you're complacent, things will drift down to the lower red quadrant over time. So you always need to be asking, how can I create more value and how can I capture that value? Whether that's through product innovations, through better marketing segmentation, through service differentiation, whatever it is, you always have to be driving up and to the right. But then there's these customers in this lower left red quadrant. And here, the first thing you need to do is look at them and say, can I create more value for some of these customers? And if you can create more value, figure out how to do so and move them up into that top left quadrant before you try to shift them over into the green. However,
I'm sorry, Stephen.
I'll just finish this, Paul, and then you can jump in. However, there's going to be some customers that you just don't know how you can create more value for. They're problem customers. Maybe they should not have been your customer in the first place. For those customers, increase prices. Some of them are likely to churn out, and that's okay. It's all right to lose customers that are not providing you with a lot of value. And if you move them over to this bottom right quadrant, well, at least you're making enough money that you can invest to figure out ways to start increasing value. Sorry, Paul, go ahead.
No, you just said exactly what I was going to say. There's sometimes churn is okay. What are you going to do? If you're not getting the value and you lose them, put your energies into some other place. So you said it better than me. Thank you.
Yeah. When you're increasing prices, you're probably going to lose some customers, and that's okay, just as long as they are not customers in that top green quadrant.
Absolutely.
Let's go on.
So what metrics are impacted by pricing that increase valuation?
So I think the key thing here are, you need to use pricing to increase your annual recurring revenue, your net recurring revenue, and your gross margin. And I just want to share a famous study done by McKinsey that analyzed more than 2,000 different companies to see what happens if there's a 1% improvement in different parts of the business. Now, I note here that many of these 2,000 companies were manufacturing companies, and SaaS economics are different, and I'll come to that in a moment. But what McKinsey found was that a 1% increase in price led on average to more than an 11% improvement in profit. A 1% decrease in variable costs led to a 7.8 improvement. A 1% increase in volume led to only a 3.3% increase in profits, and a 1% reduction in fixed costs gave only a 2.3% improvement. Now, think of all the time and effort that leadership teams put into, first of all, reducing costs, and second of all, increasing volumes. Some of that effort should go into figuring out how they can increase prices. And I would include everyone on this call, after this call, to go and build a model for your own company based on what your fixed and variable costs are, so you can get a feel for the impact that this 1% action would have, and make sure that you're putting your leadership attention in the right place. Next slide. So annual recurring revenue is, a fairly standard metric that companies get valued on. Revenue is easy. It's the number of units times price. But price has an even bigger impact on revenue for subscription companies than it does for, one-shot companies, I'll call them, because revenue continues with each renewal. And what you're trying to optimize with price is not a one-year revenue number, it's the long-term revenue. So it's important not to compromise on price just to win a deal. And pricing should maximize subscription revenue and, if necessary, discount on one-time fees. Now, for most SaaS companies, professional services and implementation and one-time fees are low margin compared to the subscription. That's generally true. And there is a feeling among some people that you should discount where you have the high margin because you have more room to discount. And this is a mistake. You should discount one-time fees, even if they are low margin, because the value of your company is being driven by the subscription revenue, and discounting subscriptions has many long-term negative impacts. Next slide. The other number that investors and buyers are paying more and more attention to is net revenue retention. And I think Paul is going to share some insights with us on, what are the benchmarks for NRR. But the critical thing to remember about NRR is that it's a composite number. It's the result of several different inputs. And it's really important to understand your inputs and how the positive factors and the negative factors are impacting you. The positive factors are what we talked about earlier, growth in package. If you have a GBB style packaging architecture, it's upsell. And then most of us have an opportunity to do cross-sell as well. The negative factors, the most important is churn. And if your churn is higher than the natural churn for your industry, you need to fix that first. Churn sucks the life out of subscription companies. And the other thing to be aware of is that anytime you have an upside, there's a potential downside. So if you use usage-based pricing, you have an opportunity to grow in package, but there's also the risk of shrinkage in package. If you have upsell, there's also the risk of downsell. People can move from your better package down into your good package, and so on. And it's really important to analyze your NRR using this waterfall. And you can have companies that have the same NRR, but very different characteristics. You might have a company that had high churn, say 10% churn, but it had growth in package of 15%, which would give it a net NRR of 5%. You might have another company that had maybe only 2% churn, but it had growth in package of only 3%. Which would give it a lower NRR. So each of these factors needs to be understood, tracked, and acted on independently, and pricing and packaging are a critical part of how you do this. So given everything we've said, what should you do next? And the most important thing, I believe, is to know your differentiation, which is not just based on your functionality. And every day, CEOs should be asking their product leads, their service leads, their sales leads, how can we increase our differentiation? And then you need a pricing strategy that will allow you to capture back part of that value. The next thing you should do is test how each of your packages and offers is performing, and is it actually playing its intended role? And even if you did a great job on the initial packaging and pricing design, if it's been in the market for more than a year, it's almost certainly drifted because the market has changed as your competitors and customers responded to you. The third thing to consider is add a pricing metric that tracks value and emphasizes your differentiation. This doesn't mean that you have to flip your business and get all of your revenue from this new pricing metric. And as I said, the Zuora research suggests that if you're getting about 20 to 30% of your revenue from a value-based usage metric, you're going to optimize revenue growth. And finally, net revenue retention is really important in today's market. It's really important to today's investors and buyers. So design to make sure that you can optimize your net revenue retention.
Awesome, Stephen. Before we get into this pricing valuation, one of the things that I had the luxury of practicing this webinar, a lot of information here. I strongly recommend that you go deeper in all aspects of this and look at the available resources. We're going to kind of change gears a little bit right now to how specifically does pricing strategy improve valuation. So if we go to the next slide, please. So I'm going to go talk about this from two different perspectives. The first one is based on the SEG's State of SaaS M&A survey. We send out a survey to the broad buyer investor community, and there's a wonderful report and analysis that you can digest on all of this. But specifically to today's topic, one of the questions we asked was, from a qualitative perspective, how would you describe an attractive SaaS company in today's market? The number one metric is a strong retention. So churn, as Stephen said, will suck the life out of your organization. It is a problem. And it's not just you're going to feel it day to day operationally with challenging financials. You're going to feel it if you try to bring your organization to market and you have retention challenges. So that is an area that absolutely should be front and center. And a strong pricing strategy can help with that, as we've seen today. We're featuring the blue bars here. The third bar, which is really close to number two, is profitability, rule of 40 gross margins. Rule of 40 is a balance of profitability and growth. Today's market is kind of leaning a little bit more towards the profitability. These things ebb and flow, but regardless, whether it's ARR growth or having good EBITDA gross margins, pricing strategy is going to help with this. I think Stephen made a very clear outline around this. That is a key area that investors want to see. And the third is growth. I mean, ARR growth. If you're a growing SaaS company, chances are you're going to continue to be continue to grow. And pricing strategy with all the segmentation and other aspects that Stephen talked about today can make a big difference. So in summary here, the better the ARR growth, the better the gross profit EBITDA margins, the better ARR retention, the reduction in churn will lead to a better valuation. I'll illustrate this on the following slide where we show some examples. So company A, and it's kind of company A before and after. Company A pre-churn. So this company is churning 15%. It's not a great number. This would be a number that I know at SEG we'd say this is an area you really want to focus on, and I'm sure you're thinking about it. Hopefully you're thinking about churn all the time within your organizations, but they're making up for it. You know, they've got an upsell of 20%. They've got new business of 10%. So ARR is growing at 15%. They've got some sort of leaks in the boat, as we like to say here, but they're making up for it. Go to a post-churn improvement. This organization was able to cut the churn in half, and they do that, good pricing strategy and other factors, customer service, product market fit, application stability and performance, all those key areas that you should be focusing as a SaaS leader. Combine that with that upsell and new business. This organization with these improvements went from 15 to 23% ARR growth. So you're going to recognize amazing benefits from this. If you train your eyes to the upper right-hand corner, due to the magic of compounding growth here, ARR, company A before versus company A after, they were able to incrementally add in this example here, $7.5 million by year 5 in increased ARR. These are significant numbers, and you would be benefiting of that all along and just enjoying a better, smoother, more formidable SaaS company. Even more exciting, if you're looking to exit your organization someday, is over that period of time, this is the difference between getting a low end of the spectrum multiple. Say in this example here, we went from 4x from a before to a 6x after you take care of churn through and just general improvements through pricing strategies. In this particular example, this organization, through all the compounding growth of the AR and all the other benefits through this pricing strategy, was able to more than double the value of this organization. So this is where the numbers can really shine. If it's your goal to eventually take an investment or to exit your organization and you want to maximize that value, taking care of these good fundamentals is absolutely critical. You know, I come back to myself as we're wrapping up this webinar here. Again, we did great with our exit. We could have done a lot better. And I think that's sort of what my mission now, working with SEG clients and will be clients someday, is to really share these kind of examples because it can make a big difference. So I think we're at a point here now where we're going to switch gears and we're going to pull up our question and answers. So if you bear with me, I'm going to pull up the questions that have come in. And it looks like we definitely have some time to answer some of these. So starting question one here, Stephen, in moving from a per user pricing to value pricing, is there a measurement reporting problem? How can the software company monitor the usage metric where the client controls the measurement of that?
So great question. If you design your SaaS application correctly, though, the application itself will do the measuring. So let me give a couple of examples. A company that provides software and hardware to improve the efficiency of water management. So they know how much water was being consumed before their application was implemented, and they actually measure the improvement in water efficiency and report on that to their customers. So the goal here should be, as you are designing what data your application collects, to collect the data that will inform your value model. And can you always do that? Not always, but you can do it more often than not. And the second part of this is most SaaS applications have integrations with other parts of the IT ecosystem. And quite often there's data that flows into your application from those other applications that can give you insight into how much value is being created. And then the final point I'd make is that value-based pricing really only works if there's trust between the vendor and the customer. And if your pricing is designed so that as you create more value for your customer, you collect more value, most customers are good with that, and they don't try to game the system. So because if they understand that you are really designing your solution to increase and make their business better, they will work with you.
Yeah, I think I could add to that a little bit. I mean, you need to be finding your value proposition for your go-to-market strategy, sales tactics, as we talked about earlier, which means it's coming from what your software can do for your clients. And I can understand that this would be, I put my my old CEO product management hat on, and I mean, it is absolutely worth the effort. I mean, you've seen the data from this webinar today to try to connect those dots so you can get to that point where you can show that value. So I imagine in some cases it'll be more difficult than others, but this would be a project I know I would be challenging my team with to figure out how can we do this, because it is so essential. Next question. Ahead of a price increase, how can I estimate the amount of churn that may result?
It's a great question. This technically we refer to this as price elasticity of demand. And there are actually two forms of price elasticity you have to think about. So one is if I increase prices, are people going to buy more? And that's price elasticity. But the second thing you need to worry about is if I increase prices, will people not necessarily buy more, but defect to one of my competitors? So estimating this is a critical part of planning a price increase. There are tools available to help you do this. But the best way to do it is to actually, well, there's two ways really to do this. One is through analysis of your historical data, where you look at variations in price and how that ties to demand. That only works if you have enough historical data and enough transactional data to really do that. The second is to work with your salespeople and say, if we had a 10% increase in price, how many deals would we lose? And listen to them and allow them to vent their concern and their worries, and then take the information they give you and put it into a demand elasticity of demand calculator. And if you reach out to me, I can provide one of those to you. And you can actually calculate that amount. There's always going to be risk and uncertainty, but business is about effectively managing risk. If you don't want to take any risks, that's an even bigger risk. So, it's not an easy question to answer, but there are ways that you can get directional information. And if you don't increase prices, you're actually going to see your company fade away over time.
Great answer. Looks like we have time for one or two more questions before we wrap up the webinar. This one is actually for me. So what is the single biggest mistake you made as a founder as it relates to pricing? Well, I kind of shared my challenges at the beginning of this, but as I prepared for this webinar, I can honestly say I think the biggest challenge I made was not paying attention to this type of content when I was a younger version of myself and growing my business. I mean, we all get caught in this routine of we've got to grow our products and the challenges of day-to-day operations. And if you have in mind, and I hear this routinely from former successful SEG clients, if you have in mind you're going to try to grow your company to get to the point where you're going to take an investment, private equity or strategic, I wish I had spent more time thinking about these types of strategic ideas and see that end result and how I could be a better end result there, because it would have changed some of our priorities as an organization. So consuming content like this, talking to people like Ibica, talking to SEG to learn more about, see yourself, doesn't have to be you're going to try to sell next year or next month, maybe 3-4 years down the road, to think about these things, because some of these projects take a lot of time before they really start to show the fruit they need to. So I think the biggest mistake I had was not just thinking about this stuff earlier. So again, I'm bearing my soul talking about these things in front of a live webinar. I think we have time for one more question, and if we can get this one in a minute or two. Stephen, what can I do if I am competing in a space with a very large vendor that offers a basic version, or what we do as part of its larger package? It is hard to compete against free.
Yeah. So this is, I think, a situation that many of us find ourselves in. And where there is some large enterprise software vendor, maybe it's SAP, maybe it's Oracle or Microsoft, or if you're in healthcare, could be Epic. And they will, first of all, the budget line for that software tends to be very large. So in the case of someone like Epic, a healthcare system could be spending $250 million on it. And the attitude of the CIO and the CFO is, we've spent all this money on this system. If it doesn't do it, it's probably not important enough to do. And meanwhile, the system, the large system is saying, we're going to do, don't worry, we got you. We're going to do that. Maybe we don't do it yet, but we kind of sort of do it, and we're good enough. And I think in 2024, we're going to see the pendulum swinging towards vendor consolidation, and the relative power of these larger companies is going to increase. And this is something that swings back and forth over the years. So a few years from now, the pendulum will probably be swinging the other way. So what are we going to do this year? The most important thing you can do is to really focus on that differentiated value and say, yes, large system does the following things, but we also do something differently. And that different thing that we do is going to give you additional money, either by increasing your revenues or reducing your operating costs or reducing your operating capital requirements and so on. And so the only way to win against these large vendors is to be very, very concrete on your differentiated value and to have evidence that you can actually deliver that value. There really is no other way.
Awesome. Well, I know there's some more questions that came in, but we want to close on time here. I assure you, we will reach out if you posed a question and we didn't get to it. We'll reach out and we'll get a response to you. So as we wrap up our discussion today, I want to take a moment to thank our guest speaker. Your experience, knowledge, and education is amazing. I personally wish I could rewind the clock and learn of this in the past. I hope my fellow founders and SaaS leaders are taking this intel to heart. It makes a big difference. As always, feel free to reach out with any questions. Now I'd like to turn it back over to Austin to close out the webinar.
Thanks, Paul. We'd love to extend our immense gratitude to our guest, Stephen, for his contribution to an outstanding conversation. Your passion and expertise is so valuable for so many in our software ecosystem. We're also immensely grateful for your participation today. And thanks you to Paul for your stories and sage advice that I'm sure resonated with many of the founders and CEOs listening in. And to the attendees, we sincerely value your engagement and participation throughout the discussion today and hope you gained some actionable takeaways from the webinar. For those of you still on, a survey will appear as you leave the webinar where you have the opportunity to submit any additional questions. And as Paul mentioned, we'll also follow up on any questions that didn't get answered throughout the webinar. Feel free to take a few minutes to fill it out, and we'll do our best to send a response as quickly as possible. We'll also be emailing a recording of today's discussion, so please be on the lookout for it. Thanks again, and I hope everybody has a wonderful rest of their week.